Great chatting. I have so many questions I want to ask. Let's get started, though, with the stuff that we kind of think we know. What are your key assumptions for next year?
Yeah, sure. Well, there are three primary assumptions, I think, major themes, let's call them, that are going to drive emerging markets in the current new year. The first is the fact that the fiscal and monetary scars from the pandemic are not going away anytime soon. I mean, we have debt loads, just to give you a frame of reference here, government debt as a percentage of GDP across the whole of emerging markets is up nearly 10 full percentage points this year to 60%. And if you just look at EM private credit as a percentage of GDP, that's up to 150%, up 20 full percentage points just over the last year alone. So that's the first theme. The second is obviously we're not going to see as much monetary stimulus out of emerging market central banks in the new year. We've seen many of them shift to neutral. And quite frankly, as we emerge from the pandemic, we're probably going to see a bit of a duration drag there. And finally, what's the pain trade in emerging markets as we look ahead to 2021? And for us, that's rate normalization in developed markets, specifically in the U.S. Treasury market, where we're already seeing the 10-year at 1%, call it. And if we do see 5-year, 30-year steepen further, I think we're at the steepest level since November of 2016. You know, markets may misinterpret that. And by that, I mean, look, it's not the level of yields, it's the rate of change that matters most to EM creditors. And if we see a sharp rise in U.S. Treasuries where the market perceives that as tighter financial conditions, we could see another 2013 taper tantrum.
It's all about perception. Perfectly, as you point out there, it's a punch you don't see coming that knocks you out. As things stand, and if we don't run into that sort of hurdle next year, talk to us about your fair value projections into 2021.
Sure. So we look at, the three pillars of emerging markets. We break them into credit, rates, and currency. So if you look at EM credit, which is 90% dollar denominated, right? The 10% is euro denominated. Really what it comes down to is we're looking for 3 to 4% returns. You're going to get 400 basis points of coupon income in the year ahead. But like I mentioned, if the U.S. Treasury curve steepens and we see yields push higher, you're going to see this duration drag eat into that total return for the year. Probably 200 basis points or so. So what's going to make up the difference? It's got to be spread compression. And when you look at EM credit, the persistent and correlation that's been in existence for the better part of the last 20 years is between EM dollar credit and U.S. high yield credit. U.S. high yield is not expected to do very well. Granted, they're plagued by convexity issues and the like, but EM dollar credit does track U.S. high yield very closely. And if we do see spreads widen in U.S. high yield, all bets are off for EM dollar credit. But we're looking for 3 to 4% returns in EM dollar credit, shifting to EM local rates. That's local rates unhedged, FX unhedged. You're talking about 2.5 to 3.5% returns. Call it 200 basis points of coupon income. But again, if these emerging market central banks aren't going to be cutting as aggressively, David, it's going to be challenging for them. And then finally, if you go to EM currencies, look, I've been in the business for nearly 3 decades now, David, and I can't find one investor who can tell me with any level of confidence where the dollar is headed next. But if you take a step back, when you're in the early stage of a growth recovery, EM currencies tend to perform very well. And so we do expect, call it +4 to -2%, an asymmetric upside move in EM currencies, at least over the first half of the year. But once the U.S. recovery sort of takes hold in the second half, it's anyone's guess as to where the dollar's headed from there.
So that kind of marks one or two major leading indicators that we're tracking here. Can I ask you then what that means for the Chinese currency, or what the Chinese currency then means for the rest of EM, especially when you look at FX, because those correlations have tightened up a little bit between the Chinese currency and where you go here with EMFX?
David, now you're speaking my language. I mean, the two primary factors that drive EM currency, spot movement, that is, in FX, is dollar yuan, and that is the greatest, kind of factor that drives EM currencies over the better part of the last, call it 2 to 3 years, and euro dollar. Now, we're emerging from 2020 where both euro dollar is up, call it 9%, dollar yuan is up 6.5%. So we've had a great environment for EM currencies to do really well, and they have. But the reality is, as we go into the new year, it's anyone's guess as to where euro dollar is going. I think the street is relatively split on that. But dollar yuan, I think, if you just look at the street, I mean, everyone's calling for it to test 620 in the year ahead, and I'm not going to argue with that. I mean, look, CGBs are the new JGBs for millennials, right? So if you just look at, it's got a stronger fundamentals, I'm talking China now, a sharper growth trajectory on the upside, and it's got wider yield differentials. So, we're pretty bullish. We have been very bullish on China government bonds, on receiving in China, and on the yuan, and I can see that continuing into the new year, at least the first half.